2, 1, bingo.
It is Sunday again. Holy moly.
Holy majolies.
These weeks tick by quick nowadays.
Yeah, man, I know. Let's wait till you're really retired next week.
Yes, sir. Next week is the last week.
Then we get to really work.
Yeah, seriously. It's not retiring. It's trading up jobs. It's graduation, actually, is how I look at it. It's not really retirement. It's graduation. Yeah.
What do you got for us this week?
All right. We're going to go back to some wisdom from the master himself, Warren Buffett. Risk comes from not knowing what you're doing, so wide diversification is only required when investors are ignorant. You only have to do a very few things in life so long as you don't do too many things wrong. Okay? So, sage advice from the master himself, and he lives it. Risk comes from not knowing what you're doing. Okay, we talked about this before on a prior show. Warren Buffett sat out the 98 to 2000 tech rally. His company Berkshire Hathaway didn't come close to beating the S&P 500 during those couple years. Financial news media and certainly his shareholders were asking him, why wasn't he invested in the biggest stock market rally in a generation? And his answer always was that he didn't understand the game at the time. He didn't know what he was doing, right, in context of that market. It was extremely risky for him because he didn't know what he was doing, so he stayed out. He didn't diversify, stay in the market, hope for the best. He's in the market when he understands what the market's doing, and that way he avoids doing too many things wrong.
We just talked about that when it was relative to Bitcoin.
Yeah,
Buffett.
right.
I was telling Jerry about a quote I heard from Warren Buffett about Bitcoin, and I was like, I know this is a smart man. Why is he saying this? And it goes back to he admits when he doesn't understand something.
Right.
So It's not that he doesn't. He just knows that he doesn't, and he's not in that game.
Right.
And
right. So he's not diversifying. I'll throw a little bit into Bitcoin. No, the risk is when you do things that you don't know anything about what you're doing.
It. Right. Yeah.
So the reason I did the risk quote is because we're gonna talk about risk today.
Yeah.
This is going to be the first in a 2-week series of risk.
You didn't warn me it was a 2-part series.
It's a 2-part series. Next week is going to be this week is going to be basically the conventional wisdom of risk and our view of risk, which, as you could imagine, is different than the conventional wisdom.
No way we're different.
Yeah, no. So then we're going to show what the conventional wisdom is and actually how the L fund gives TSP investors a mechanism to invest based on the conventional wisdom, right? And then we're going to show kind of how Grow My TSP looks at risk and a chart, of course, that shows, and I'll walk through this chart about what risk really means. And so we'll get to all that. But first things first, it was another 2 weeks in a row, green across the board for all the TSP funds, including the F fund. So C fund was up 1.37, S fund up 1.38, I fund was the leader at 1.67, and the F fund was up 0.32. We'll talk about the F fund at the end. I don't know what happened on Thursday. It's a pretty crazy looking day in the F fund, which nobody ever looks at, but I kind of think it had to do with on Thursday, the administration came out and did some big sanctions against Russia, and it had to do with us allowing their ability to trade in the financial markets, and I think that affected bond prices a lot.
You're sounding like a fundamentalist right now.
Well, when you see the when you see the chart, you're gonna be like, oh, okay, that the news must have meant something that day because it's pretty crazy. Okay. So, like we said, first in a 2-part series. Next week, we're going to talk about how your risk tolerance changes over the course of your life and how this can affect your reallocation decisions. So, while this week we're going to sort of make an argument that risk applies evenly to everybody, it doesn't mean that your personal circumstances don't come into play as you're making reallocation decisions along the course of your life. So, what is risk? Conventional wisdom, and how the L funds give you a mechanism to invest in the conventional wisdom, the Grow My TSP perspective, and then the bonus chart this week is going to be Plug. Pretty interesting what's happened with Plug. It's a hydrogen fuel cell company based out of New York. We'll talk about that. And then AMRN, if you've been watching the show for the last few weeks, I've bought and sold AMRN a few times, and I had a little life happens snafu last week that I'll sort of share some of the highlights of, and explain why two-factor authentication and your phone number are something that if you never thought very much about, you better make sure you get some backups. And then we'll get to the daily charts. All right. So the conventional, I mean, we've all heard this, right? The first, I basically chunked it up into thirds of your career, right? You get on the job, you're 25 years old, and your boss says, hey, you're just starting out your career. Since we know the market always goes up, you have plenty of time to recover any paper losses that you might, Conan's going to throw a dart at me because I said paper losses. He's all wound up about that term right now. But you have plenty of time to recover from any paper losses, right? You can afford to be risky, so put all your money in the S&C and S funds, okay? Then somewhere in the middle of your career, you kind of wake up and you go, all right, I'm in the middle of my career. I'm starting a little bit to think about retirement. Maybe it's time not to be quite so risky, right? Maybe now's the time to allocate some of my funds, take some of the money off the table, go to the F and G maybe a little bit, right? And then you get towards the end of your career, or you're already in retirement. You need the TSP to supplement your pension, okay? You can't afford to take risks anymore because you can't afford to lose it. So you reallocate everything to the safety of the G fund. And that's basically the conventional wisdom of how people invest in TSP. And it's what we've all been taught, basically, with the help of BlackRock, since the beginning of TSP in 1986, I guess. So this conventional wisdom, if you can't tell from these three sections, it's all based on your age and proximity to or needing to use TSP funds in retirement. It's based on you and your age, okay? And here's how the L funds...
That's a lot of text.
Yeah, I know, and I was going to kind of highlight some of it, but it's all kind of important. So, and if you don't understand the L funds, you're going to hear at the end of this little minute. Right now there are 10 L funds because they, within the last year or two, changed it from an L fund being every 10 years to every 5 years. But that's kind of not the point.
They added it, not changed it, right? So you got 10 and 5.
You have 10 funds, and yes, you have 10. Well, every 5 years is a new L fund. Yeah. So the L funds are not funds, as Conan likes to say. The L funds are a portfolio. They're a portfolio of the core C, F, S, I, and G, right? They're not their own funds. They're a mixture of the core funds.
It does drive me crazy.
Yeah, no, I know.
It's a portfolio. Why did you call it? You're not buying a fund?
No, it's not an individual fund. And so just so you know, I took this, I copy and paste this off the TSP website, right? I didn't use any.
These aren't your words?
These are not my words.
They called it a portfolio?
This doesn't their entire portfolio into a single fund. Yes, this is their words. This is what they said.
Okay.
So they were designed to let you invest your entire portfolio, which means your personal portfolio in the TSP, right, into a single L fund, so that you don't have to keep moving between some of C, some of S, some of I. They let you do it all in one move, right? They say L 2050. I change that, and I've changed all of it with just one move. And here's the important part of this first paragraph: and get the best expected return for the amount of expected risk that is appropriate to you. Okay,
that's a loaded sentence.
They're telling you what kind of risk you should expect, and they're telling you that it's appropriate to you, and that it's relative to you, as if risk is relative to you.
And how do they know that?
I don't know.
Oh.
I have no idea how they would know that.
I thought you figured it out.
Well, it's a nonsensical statement, so they can't know it. Okay. Here's the thing that people get confused about the L funds. Every quarter, every 3 months, the target allocations for the L funds, except for the L income, so forget about the L income fund. It's basically almost 100% G. It's the fund that they want you in when you're retired. But every quarter, the target allocation funds gradually shifts from quote, higher risk and reward to lower risk and reward as they get closer to the target date. Okay. So if you're in a L2060 fund, say that's the furthest one out, that's the one that has the highest percentages in the stock funds, right? As you say, the 2055 fund has a little bit less in the stocks and a little bit more in the F&G. And as you get closer to the year that you're going to retire, it decreases the percentage that you're in the stocks and it increases the percentage you're in the F&G.
Regardless of what the market's doing.
Regardless of what the market's doing. So they put in there's an algorithm. I shouldn't really call it an algorithm. A long time ago, they used to have a really cool little pictogram thing on the TSP website that you clicked on it and it would show this wheel spinning, and it showed the percentage of each of the funds that you had, and it showed how over, it just sped up the quarters, and it showed how it decreased in the CNS&I and increased in the F&G and to the end of the fund life. So it's just every quarter it decreases by a certain amount. So that is what facilitates the idea that as you age, you want to decrease your quote unquote risk, right? Because we all know, in quotes, because this is all ridiculous, we all know that the stock funds are riskier than the F and G fund. Okay. So when an L fund reaches its target date, it goes out of existence. Any money in it becomes part of the L income fund, which generally keeps the same allocation target. Yeah, it's basically 100% G and F. Okay. So that's how the quarterly reallocations work. And for the third paragraph here, one of the important things about the L fund is that they stick to their target allocations for a full quarter regardless of what the market does. Okay?
As if that's a good thing.
As if, yeah.
I just like to add these little commentaries. Go ahead.
Here's the important thing, because there's a quarterly piece that quarterly it changes the algorithm, but daily it rebalances daily to make sure that you stay within the percentage that it ascribed to for that quarter. Okay, so and they say this as a positive at the end, but every trading day, some of the core funds in the L funds will do better than the others, right? Because we know that the S might go up more or less than the C on any given day. At the end of the day, the core funds that did better will make up a higher percentage of the L than the ones that did less well that day, which makes sense, right? That's obvious. To maintain each L fund's target allocation, we rebalance it at the end of every trading day. We do this by buying and selling the core funds that make up the L fund so that the percentages go back to what they were at the beginning of the day, right? So if at the beginning of the day, let's just pretend that the allocation said that the percentages should be 50 C and 50 S, right? If the S went up 2% and the C went down 2% that day, you got the gains in the S fund, right? You got the losses in the C fund. When they rebalance at the end of the day, they bring your account back so that the next day you are still 50% exposed to C and 50% S. They're saying that what that does in effect is we're buying low and selling high at the end of every trading day. What's actually happening is if the S is going up 2% and the C is going down 2%, me personally, I'm looking at the S going up like that's where I want to be in. I don't want you selling my S to buy C that just went down 2%.
Right.
I want you to sell more of my C, buy more of my S because that's going up.
and exactly, but the reality is it's never like 2% and 2%. So
right.
if we put that analogy, then it makes it seem like, oh, it just flattens out. It's no big deal. Well, what if it was 10% and 2%?
Right.
And now or the other way around. Right?
Yeah, that would be worse actually.
Exactly.
Right.
So
if a stock is tanking, why do I want to be in it?
Why can't you let my winning horses
keep
running?
Let the winners run and cut the losses short. And that's an investor's business daily way of looking at things. It's a way that the traders, and it doesn't have to be day trading. It's a way that you invest in the market
it's
to be
market
in
strategy. Yeah.
Yeah, to be in when in the stocks or funds or companies or whatever that are going higher. You don't want to be go back to the Warren Buffett quote. You don't want to be well diversified. I don't want to be in anything that's going down.
Right. If you can help it.
If I can help it. And the L funds, they don't take any of this stuff into consideration because they needed a very simple algorithm to sell you.
That's exactly it. You just nailed it. So that was going to be my input, was that we know why they do this. That's because the majority of the population of people that are that are listening to this and in the TSP anything are listening to the conventional wisdom, right? Which tells them these things. So if you're the people that make the decisions for the L funds, you go, well, let's just tell them what they want to hear. Because if we tell them what they want to hear, that's what everybody else is saying. They'll buy into it, right?
Yeah.
And the thing is we get to pretend like we're actively managing your retirement account,
right?
When you're not really.
This is not active management,
right? And it's passive management, but it's automated. Active is not the right word, and neither is passive. It's a way of finding a way to doing it automatically with weird rules. Yeah. Right.
Well, the thing for me is the core of the rule set, right? Because the core of the rule set is the idea that risk is based on your age and or proximity to needing to withdraw funds from TSP to supplement your pension. But the next thing we're going to go to is what our perspective of risk and why it makes a lot more sense. Okay. So generally, right, so our definition of risk obviously is drastically different from the conventional wisdom. From our perspective, risk is primarily, if not completely, based on the market, okay? So generally speaking, the market has long periods of relative slow price increase with relatively short but fast periods of significant price decline, right? Take last March, we lost 34% on the C fund in a month. Right? We've been going up, and then kaboom, 34% gets cut off. That's just what happens. You can, that's just how the market works. The market gains and losses apply to everyone, right? If no matter where you were in your career or how much you had in your TSP, whether L funds or this fund or whatever fund you were in, the C fund took a 34% hit last March, whether you're 25 years old or 55 years old. If you were in the market, you took that loss. Market doesn't care about you, your age, your proximity to retirement, or your financial goals. The market does what it does. So if it makes no sense to me to base a concept of investment on a thing that is not correlated to the actual thing that you're trying to be involved in or hedge against. I just can't even get my mind around it. And it's so completely sold that conventional wisdom. I just can't get my mind around it. So we know your account grows faster the more you have in it, right? That's compounding. It's basically a snowball is the example that I always use. So the more you have in your account, the faster it grows, which is why our number one rule is don't lose money. Because if you take big losses, it takes you that much longer to get back up to where you were in the first place. And so really risk, there are only really two types of risk. It's the risk of loss or the risk of not getting gains, right? The risk of opportunity. So in general, that sort of is the summary of the difference between our perspective on risk and the conventional wisdom. And all of this, our perspective is all based on what the market does. None of it is based on you and your age and your goals and your hopes and dreams or whatever. It's
right. And that's where people, and hopefully we can kind of chop this out to have a quick explanation of our perspective, because a lot of times what we get is these questions about, well, what should I do if, and what should I do if? And we're like, we don't know, because we don't know what the market's going to be doing tomorrow.
Right.
That's always first. Second is we don't have any idea of your personal circumstances, your risk for your tolerance for risk. None of these things we don't know, so can't give you that answer. Right. The biggest one is we don't know what the market's going to do.
Right. That's the. I mean, obviously we see it every day. These are my circumstances. What should I do? It is an unanswerable question. It's very answerable if you're using conventional wisdom. It's well, how old are you? When you're going to retire? Oh, this is what
are
you
your
do.
plans? Are you going to send your kids to college? Are you going to stay and work? All these things that have absolutely nothing to do with how the market's going to play out with your retirement account.
Right. Those are the things we're going to talk about next week.
Boom.
Because at some point, you do need to start thinking about, like, let's say I'm a year out from retirement and I'm going to take a withdrawal from TSP and use it to pay off my house. Okay. That is an example of a circumstance where I don't care what the market's doing. I need to use that money for something else.
Right.
TSP at the end of the day is a tool for you to live your life, right? And it's not about how much really can I gain in TSP. It's how much can I gain in TSP so that I can use it to do what I want to do when I retire, right? So at some point we got to take that into consideration, and that's what we're going to do next week.
Good.
Okay. So here's a chart, of course, sort of to walk through our concept of risk. And I'm going to use a personal example. I asked my mom if I could do it. So
you had to ask
I had to ask my mom.
You had to ask permission?
Yeah. Because it's not really my example, it's hers.
Oh, okay. I've never heard you ask permission.
Yeah, I had to ask permission from my mom. So when all of us kids got out of the house, my mom went back to work for the government. And she went back in 1990, I think it was. So I didn't put the chart any further back, but if anybody who remembers, we were kind of flat here and actually to down. But so the market had come up; it had been going flat for a while. My mom gets back into the government, like right here. She worked for 10 years. She gets out right there. She's the luckiest person going.
Right.
It was ridiculous how lucky she got. Right.
Yeah.
No.
That wasn't planning.
No. Nothing.
This is when like, hey, I know the market's going to be there when I retire, so that's when I'm going to retire.
No. She got really lucky. My dad, I know, was tracking it, but of course he didn't know what was going to happen down here. But my mom retires up here, and she did really well for those 10 years. She maxed out her TSP because her kids were out of the house and whatever, and it was great. But if you shifted that, so let's just say, because we can't do the compounding, it gets very complicated, the math and all that. Let's say she got in here, and let's say that's $250. So this is the 500 line. So let's say this is $250. So the C fund, let's say, is worth $250 when she got in. She retires up here, and it's $1,500. Right. So let's make it even simpler. Let's say she gets in, and the price is $500, and she gets out, and it's $1,500. Right. So if she had $1,000 or whatever.
Yeah, make a bigger market, 1,500, so people can see what you're talking about.
Yeah,
right there.
1,500 is right there. Yeah. 1,500. So her initial $1,000, let's just say, in her account down here, went up 300%. Right. It's a pretty huge move. It's awesome. What if she had kids 10 years later? Or she was born 10 years later, however you want to put it. What if she got back into the government when it was $1,500, and she got out 10 years later?
Yeah.
I mean, the market doesn't always go up.
Right. Are you telling me the market didn't care that her career was going to start in 2000 and end in?
The market cares about my mom. I mean, I know the market cares about everybody's mom. Come on, it's almost Mother's Day, dude. The market doesn't care about me. I know that, but I know it cares about everybody's mom.
Yeah.
Yeah. No.
I hope people are getting the sarcasm because that's. What's funny is where you drew. I mean, that's basically where I came back into the government. For the rest of the time was in 2000 time frame, and when I started following you religiously was in 2008, right before end of 2007, 2008.
Yeah.
And didn't understand most of this until like 2012 or 13.
Yeah.
But seeing all that play out was amazing, because this whole idea of the market always goes up. All the things that we talk about, we belabor it, but we mostly do because we never know, who's coming in to watch this. This is the first time they hear this, so we have to kind of throw these things out. Even those of you that watch us every week are like, all right, we got it.
Absolutely.
But that chart is exactly how it would play out depending on when you came in.
Yep.
And so if you're convinced that I should just put my money in and it rebalances every quarter, it rebalances every day, and changes allocations every quarter.
Yep.
How would that play out for you in that scenario?
Yeah.
Where you just got out in that 10 years? How would that play out? Not so well.
Not so well. I mean,
Because you're early on in your career, according to the government.
If you're 25 and you're getting in right here in 2000,
yep,
and say you have $1,000 in your, in your TSP or whatever, you watched it take a 50% loss. You came back up to even. Now you made your money back. Your original
$1,000.
Yeah. Yep. Now, given this is a simplistic example, right? Because you're contributing, and
we can't use that right now. Yeah.
So let's just say you start off with $1,000 right here. This was in 2000. In 2008, so 9 years later, because this is the beginning of June. That's the middle. All right. So 8 years later, you're back to where you started. You're almost halfway. If you're a 6C guy, you're almost halfway through your 20-year 6C, right? You're back to where you started. Then, as soon as you get back to where you started, you lost 55%, right? Then to get back again was 2013. So the $1,000 that you invested in 2000, if you did the buy and hold and rode the ups and downs, and you actually had the stomach not to sell here and here, you did the buy and hold, the ups and downs, it took you from 2000 to 2013 to get back to where you were.
Mm-hmm. And I'm going to stay away from the whole paper loss thing. I'm not going to get in there.
Not today.
But for those of you that are just dying to say while you're watching this, but that was just a paper loss, just hold on, because we're getting ready to publish an article that tells you the difference between paper loss and as an individual investor in the market and what we're talking about in a retirement account. It's not the same.
If I do a little highlight, will it suck you into the conversation? It'll make this a 3-hour show, or can I do that? Can I do a little example of why?
Yeah. Okay. Go ahead if you're prepared.
All right, here we go. I'm not prepared, but I'm gonna wing it. You got $1,000 here at $1,500. Okay, and it comes down here to $750. That's a 50% loss. If I had $1,000 in here, and I sold it, again, no one's talking about market timing. You're not going to buy it, or you're not going to sell it at the top. You're not going to buy it at the bottom. But for an example, I had $1,000 here. I sold it. My $1,000 here, so this was a 50% loss, right? But I didn't take any of that loss. So I have $1,000 down here. When the market comes back up to where it was before, it's a 100% gain. So my $1,000 that I had here and sold, I maintained to down here. I still have my 1,000 here, and I get back in. Up here, when I get back to where I was originally, now I have $2,000. Okay? If I did the same thing here, I had 2,000. Say this was a 50% loss also. I have 2,000 here. In 2013, I got $4,000.
If you got in and out.
If I got in and out those 2 times.
Right.
Versus this guy who has 1,000 and rode it up and down, did the buy and hold, still has 1,000.
Yeah. Because what most people don't understand about paper loss is that is not that
it's real.
It's not in our account. It's not paper. We're not buying and selling shares and taking loss and gains like you do with taxable event.
Yep.
The bottom line is we don't have to go into all that.
Yeah.
We'll get an article. But the bottom line is your account goes down. It's a real loss. Yep. If your bank account goes down, it doesn't get more real than that. Right. If it goes from $1,000 to $500 or whatever, and then goes back up to $1,000, that's not paper. No. That's not the same thing.
It's opportunity. It's the thing that is enabling your account to grow. So the fact that you aren't spending it on ice cream cones that's not what makes it real. What makes it real is your ability to use it.
Yeah.
And if it's not there, you can't use it.
Yeah. And it is true that the impact doesn't happen until you actually withdraw.
Right. The taxable event doesn't happen.
That's the event. And so if we know we're not withdrawing, we don't want to ride that out the way you just got. Well, you've erased all of it, but yeah. Hopefully everybody kind of got that concept, because it's huge, particularly to the way we do this methodology.
It's the core to the whole thing.
Right. We don't want to lose money. That's why, if people notice over time, Jerry is much quicker to get out than he is to get in, because the first rule is don't lose money. Right. So we're not getting back in until we're confident with a high probability that the trend has changed. Right. Right. Not that yesterday the trend changed, but that it's trending. Right. And the line is in the sand. Once it crosses that line, we know that the trend has changed. Right. And then we're like, all right, well, we're comfortable getting back in. That means you're not going to be able to get in at the bottom.
Right.
It's not going to happen.
Not. It's not going to happen.
Yeah. We're definitely not going to.
Yeah.
All right.
Okay.
Good little
That was pretty good,
sidebar.
Right? Yeah, sidebar. Okay. Bonus chart. Plug. Plug is Latham, I think how you say that, New York based company. It's a leader in hydrogen fuel cells that are used in forklifts in large warehouses. Okay, fuel cells replace conventional batteries in equipment and vehicles that are electrically powered, and they have contracts with, obviously warehouse giants like Amazon, Walmart, Nike, and Home Depot. Okay, as you would expect, when the administration came in, Biden administration, like most other green type stocks, Plug absolutely took off. So it was $15 down here. It, if you can kind of see the light gray behind that price is volume. You see how big the volume is that day? I mean, monster volume. Coming off of support there at its 10-day and 50-day moving average line. Perfect time to buy it. Had a giant run, right? Huge run. Great. Then it has this, you could call it a head and shoulders, sort of, if you wanted to. It's some kind of sideways consolidation pattern, right? And it's running along its 10-day moving average line. So where is the time? What's the line in the sand, basically? I mean, just really roughly, if I'm drawing a line across like that, if it goes below that line and below the 10-day moving average, which it did on that huge down day, right? You got to get out.
The trend has changed.
The trend has clearly changed. Ordinarily, well, I shouldn't say ordinarily, but yeah, ordinarily, price comes up, we have some kind of consolidation, and the price continues in the same direction. But it doesn't always happen that way. That's why when you draw trend lines, channel lines, if this had continued like this and then broke up here, this would have been another good time to buy it. But it didn't do that. It broke below the channel line, so that was definitely the time to sell it. And then Plug went basically all the way back, and it's still going down, but it's almost back to where it was back here. On the plus side, there's not a lot of plus side. It's even Friday had a giant down day and big volume. I mean, we might be getting close to seeing the end of the decline for Plug, but it's not something that I would look at buying. I just wanted to show it as an example of topping patterns that don't always, consolidation patterns that don't always play out to continue in the direction of the prior trend. That's why when the trend changes, it doesn't usually actually change on a dime, right? You see a lot of times the chart does like this, and then it comes crashing down like that. More often than not, you have some kind of churning at the top.
Even with individual stocks, and you can say that more so for indexes,
right?
And it's the reason why there's such a push for individual investors to go towards indexes rather than individual stocks, because most people don't have time to watch the volatility of stocks. If you're in an index, that happens slower.
Yeah.
There's not normally this,
Right.
right? There you get a lot of warning.
Yep.
And that's why the TSP is made up of index. It's the very same reason.
Yeah, it does. It definitely decreases the volatility versus stocks. I mean, you can see huge volume here as the run up is happening, which is great. Very light volume here during the consolidation, which is fine because you just don't know. You don't know which way it's going to go, and then volume starts picking up on the decline. Yeah, so plug is not something I'd want to be in. But anyway, I think you got the gist of the idea. Okay, AMRN. Life happens. So my phone got stolen a week or so ago, whatever. I was in AMRN. I can't remember right now where exactly I had. At one point, when I first showed this, I bought it here. I sold it there. I bought back in I think it was right there. My phone got stolen right there.
Sorry, man. I don't mean to laugh at your life event.
Yeah. So
I remember this life event like it was yesterday.
I imagine.
A few days ago.
Yeah. So
Jerry called me and said, "I got a new phone number."
Here's the problem with to finish up my little thing with AMRN, it gapped down 10% that day. That was the day ultimately I was able to get out, and I got out at right around 540 probably, and it closed that day a little over $5. So I was lucky I was able to get out of it. And in reality, because I am watching it, I would have gotten out on, you see that reversal day,
mm-hmm.
where it ultimately closed below the 10-day moving average. That would have been the day I would have gotten out.
But why didn't you?
What
did losing your phone have to do with that?
Well, there's a thing called two-factor authentication. And Robinhood which is where I trade AMRN. When you log into Robinhood, you got your username and password. That's great. You hit send, and it sends you a text to your phone, and it wants the code that it sent you, right? If you don't have that number, if you don't have access to that number, you can't put the code in. If you can't put the code in, you can't get into your account. If you can't get into your account, you can't sell AMRN when it's crashing below the 10-day moving average. Not only that, you can't get into TSP.
Right.
So I called the TSP, and since we're all government, military, we'll get. It's not going to get too far into the weeds. Everybody's going to understand what I'm saying. I called the TSP help desk. I'm sitting in a hotel room. I don't have my phone. I have a different phone. I don't have my phone that this two-factor authentication thing is attached to. I'm talking to TSP on the phone. The woman at the help desk is trying to validate who I am, which is what she's supposed to do, right? Name, date of birth, address, social security number, all that. Great. What was the last amount that you contributed to the penny the last time that your TSP, you contributed to TSP for my last paycheck? And I'm like, how would I possibly know that? And I'm thinking, all right, wait, hold on. I can figure that out. I get on my laptop. I pull up NFC, right? National Finance Center. And I log in because I can tell from NFC on my last earnings statement how much I contributed to TSP. Log in, no problem. Hit send. Thunk. Tell us the code for two-factor authentication. I'm like, oh, okay, I get it. I'm screwed. I got it. I got it.
Just
yeah, I mean the importance of that phone number. And I know people are rolling their eyes and they're like, well, you can put in your email address, and not all sites can you put in the email address.
Just for everybody's sake, we have figured out a solution for Jerry because I showed him how to do. Because what I use is a virtual number for that, and so I can I can get to that text message somewhere else. I don't have to have that phone, and that's what we're setting up for Jerry.
Yeah.
But, so there are other ways around it, but if you don't think about it,
right?
You're just like, oh, who cares? Like, it sends me this text. What if you don't have that phone?
If you lose that phone,
and
you don't have the ability to do the two-factor authentication thing, you're screwed. In so many ways in your life, it's unbelievable how much you are attached to that number.
Is. Yeah. And getting it switched over quickly is not
Took me
quick.
5 days. Yeah, no joke. I forgot. We still got to do. All right, let's take a commercial break. No, we can't take a commercial break.
We don't
All
have
right.
don't have that option.
All right, here we go for the weekly TSP fund charts. Okay, C fund $SPX, S fund $DWCPF. I fund is Europe Asia Far East Index is EFA, and AGG is the aggregate bond index is the F fund. So we put up this chart several months ago. Was my first attempt to try to figure out, because we know that this is a 4, and we know that somewhere up here is the 5. If anybody's been watching this show for the last few weeks, we've been talking about Elliott Wave. We know that this is a 4. I'm not going to get into right now why we know that, but we definitely know it. That's a 4.
Just accept it.
And this is the 5. So the channel. So what we should see is 1, 2. This is going to be 3, some kind of 4, and 5. So it'll be something like that, right? The timing, don't worry about that. I don't know what it's going to turn out to be, but the channel are the guidelines that I'm using to make sure we're still in the channel that's going to end up there. We don't have to get a 5 up here. I mean, this could roll over and go down and still be within the rules of the bigger Elliott Wave because we're already above the 3. So it could happen. And more likely than not, the probability is that we get a 3, 4, 5. Okay. So the only reason I put this chart up is just to show that we are right in the middle, actually, of the 5 wave, the 5 legs within the 5th wave. We are right in the middle of the channel right there. Okay. So if we were to get a little blip sometime, and even if the C fund came all the way back down to its 50-day moving average line, the red line, which incidentally is almost 6%. So it's not like I would like to take that loss. But even if we did take that loss, we're still within the channel. Mm-hmm. Right? So my bias is basically bullish is where I'm getting to. As long as we are within this channel, my longer term bias is bullish. Okay. So here's what the C fund looks like on a daily basis for the last 6 months. We were in a pretty good, a pretty decent kind of channel here. And now we're clearly out of it to the upside, which is a good thing. It's fine. If we roll back over, 10-day moving average is not too far above the channel line. So if we did roll over and we're not able to get support at the 10-day moving average line, I'd probably stay in until that channel line, that upper trend line, just because I think we're likely to find support there. So like I said, I'm bullish. The bias is bullish. So the C fund's doing really well. There's a couple things I would say about it. Volume isn't decreasing too badly, but it's not certainly not increasing. So as price goes up, it would be better to see volume go up, but it's not. Volume's going down. It's overbought on the RSI. That's not a horrible thing. It can stay overbought. It can stay over that 70 line and in that green area there for a long time, and price can continue to go higher. That's not a problem. The MACD is showing no indication of rolling over. Mm-hmm. Right? So it's all good. It looks strong. The biggest thing for me really is this 6% problem. Because if from here where we are right now to the 50-day is about a 6% loss. And so that's your risk, because every time it's broke, it usually rides the 10-day moving average line. But when it doesn't and it breaks through, it gets support at the 50. Basically gets support at the 50. So if it came down here, broke the 10-day, got support at the 50, you're already in a 6% loss that you've already taken. So I hate that. It's overvalued. It's overextended. Not overvalued. It's overextended. And that to me represents risk. And it's not just to me. It represents a 6% potential risk right now. So that's the only thing I don't like about the C fund. But technically, it's in pretty good shape. It's in very good shape. S fund, we had a big run up. We get an ABC consolidation. We got a little move higher, not a whole lot, but then we got consolidation along that 50-day moving average line. We got the red line, which is the 10-day, crossing up through the 50-day, right? Very bullish sign. And we had support there along the 50-day, and then on Thursday, actually Wednesday, we had a reversal, but then on Thursday, we went higher. Friday was a down day, no big deal. S fund I like because it looks like we had the initial move was up, ABC consolidation, and it continues in the same direction. That's my plan A right now for the S fund. We got plenty of room here, right? You can see how long you can stay over, supposedly overbought from the RSI. I mean, that's from here to here, right? That's a huge price move. We have a long way to go before the RSI. So what I'm saying is the indicators support it. So MACD down here has just recently crossed, and the high is over here. We have a long way to go, as opposed to the C fund where we're already as high as we were back here. You know, and the RSI has already topped out. So there's a lot more potential, from my perspective, for gains in the S fund than there is in the C fund. Doesn't mean it's going to play out that way, but that's the way I see it. I fund is kind of similar. We have shown this chart for the last couple of weeks, this bullish triangle. Had a breakout on that day. Had a couple days of, testing the breakout, and then this week the I fund really kind of took off. It was the leading fund for the week. So I fund, I'm back on. Okay. I fund looks good. We still definitely have room because you get this whole area in here where you can see it's over that 70% line on the RSI, and now we're just starting to get there again. MACD looks good. It's still well below this high. I fund looks really good. A couple of weeks ago, we put up a chart about and talked a little bit about the potential of the I fund relative to the C fund outperforming. And I went back and actually looked at that chart, and we're not there yet. Even though the I fund outperformed for the week, the long-term ratio of the I to the C has not made the turn at the bottom yet. So I'm going to put a chart up of that next week, and it'll definitely be telling depending on what the I fund does this week. But either way, I don't think the I fund is there yet, which is why I don't own it yet. Okay. F fund. This was the F fund last week. It was a great example of the Elliott Wave. You got 1, A, B, C for 2, 3, A, B, C for 4, and we were just waiting for the fund to come down, right? And we were saying that if the C fund is overextended and the F fund is getting close to a bottom, maybe sometime in May or something like that, we roll out of the C and into the F, and maybe the F starts coming back up. It never works as simple as you think, simple as it would seemingly be. Here's what the F fund looks like now. So this was just last week, right? We're pretty well below the 10-day, the 50-day moving average, the blue line, right? Here's what we look like this week. This day, Thursday, the administration came out with a new set of sanctions against Russia, and it had to do with their ability to trade, to buy and sell, not stocks and stuff. It's big money stuff that's way over my head. However, it clearly affected bond prices, because just to say that we have an outside day here, an outside day is when the high is higher than the previous high and the low is lower than the previous low in the day. So the candlestick is like this, And yesterday's candlestick was like that. This is an outside day, right? And an inside day would be that, right? This outside day takes out like almost a month. This is giant candlestick. Huge, right? So there was a lot of fear and angst, and that's kind of what that represents. At the end of the day, on Thursday, it closed above the what's the red? The 50-day moving average. But then on Friday, things started kind of settling out, and we're back down again below the 50-day moving average. This is my final line in the sand. So if this is a 2-leg right here, and this is a 4-leg, the 4 can't get any higher. It's time-wise, it's very similar, and the 2 was flat, and the 4 was extended up. That's good. That's how it should look. But if we continue higher and get support as the 50-day moving average continues, if we stay above that 50-day, eventually it'll start turning. This will be a failed Elliott Wave pattern. This 1, 2, 3. This will be the bottom. And then so then we'll F fund will do like that. So it's possible that it's already turned. I'm not 100% there yet. The technical indicators aren't really telling us anything yet. So I'm kind of looking forward to seeing what happens this week. My plan A is still that we are 1, 2, 3, 4, and we get a 5. That's my plan A. But again, I don't put any. I don't really trade the F fund, but it was a good example of Elliott Wave. Yeah, in the funds.
Yeah, it's funny you say you don't normally trade the F fund, but when we're very close to putting our performance numbers up on the site. We're just trying to put up a lot of explanation stuff with it because you can't just look at numbers without some sort of explanation. But I came across what I thought at the time was kind of funny, where a point in which last year every other fund was negative,
yep,
and the F fund was positive, which makes sense, and we were in the F fund.
Yep.
Not all in, right? Because we were still trying to protect some, but we were in,
right,
and we had a positive gain that month when every other fund had a negative one.
Yep.
And those are the kind of things that once you understand our methodology,
yep,
it proves it. You just say, look, I didn't care anything about the F fund. All I cared about is that it was trending up.
Right.
Everything else was trending down. Let me take a little bit, put a little on the table,
yep,
and see what it does. Oh, I got a little 4% hike.
In the one that's trending up. Yeah.
Yeah. It had nothing to do with whether I'm retiring tomorrow, right, buying a house,
right.
Yeah, none of that stuff. And who would think that the F fund was going to outperform all of those? You can't think.
You can see it in the chart.
It's
the only way you
look at the data.
Right.
It's going up.
Right.
It's trending up. I don't care what the letter is.
Right.
That's
all there is to it.
Is it question time?
Questions.
All right. We never get any questions. Oh, that's because nobody can talk to us.
Yeah.
We get lots of questions. They're just after the show.
Yeah, questions.
If you have questions, please put them in the comments. If you watch it on YouTube, put it there. If you watch it on Facebook, put them in the comments there. We'll do our best to, reply to those comments. If you have positive comments, they feel good. If you have negative ones,
they feel good too.
They don't. We
don't
don't
feel that good, but that's fine.
Yeah.
If you are a subscriber to the site, definitely go to search for the members only Facebook group.
Yes, a members only Facebook group. Still have a lot of folks that are members that are not in it, but there are a lot of people that aren't on Facebook or don't have any interest, and that's fine. If you are on Facebook and you are a member, there is a members only group that we have to validate you to get in.
Yes, that's the other thing. You have to put in your name, your actual name, not your Facebook name, your actual name, and your email address that is associated with your Grow My TSP membership, because if you don't, I cannot validate you into the group.
Can't do it.
I don't have a mechanism to do it. I can't because I don't want to. Can't because
you don't have
I'm not able to.
You don't have a genie in the bottle.
No.
All right, guys, that's our show for this week. Hope you have a great week, and hope you had a great weekend.
Peace.
Cue music.
Dun, dun.